Health Savings Account HSA. The triple tax advantage nobody uses. Most Americans are throwing away $8,000 a year in free tax savings. And they have no idea it's sitting there. I'm talking about the Health Savings Account, the HSA. And here's the wild part. It's literally the only investment account in America with 3 different tax advantages stacked on top of each other. Your 401k? Single tax break. Your Roth IRA? Single tax break. But an HSA? Triple threat. And today I'm showing you exactly how to weaponize this account to build serious wealth while simultaneously saving thousands on taxes. Let's go. Here's what nobody tells you about HSAs. First, let me be clear about what we're talking about. An HSA is a savings account specifically designed for people with high deductible health insurance plans. That's the key unlock right there. You can't just open an HSA with any insurance plan. It has to be a qualified high deductible plan. In 2024, that means your deductible needs to be at least $1,300 for individual coverage or $2,600 for family coverage. If you're on your employer's plan, check with HR. If you're self-employed, you can shop on healthcare.gov. Most people think this is a downside, but it's actually the gateway to the most powerful wealth-building tool they'll ever touch. Here's the structure, and it's important you understand this part because most articles gloss over it. The triple tax advantage. Broken down. Tax advantage number 1. Contributions are tax deductible. Your employer can contribute up to $3,900 per year for individual coverage. Completely pre-tax. Your paycheck doesn't get hit. It's like free money from the government. If you're self-employed, you get the same $8,100 for family coverage. Also deductible from your income taxes. That alone saves you maybe $1,000 if you're in the 24% tax bracket. But that's just the appetizer. Tax advantage number 2. The money grows tax-free. This is where it gets interesting. Whatever you put into your HSA, you can invest it. Most people don't know this. They think HSAs are just savings accounts. Wrong. Open one with Fidelity, Vanguard, or Robinhood. Yes, Robinhood has HSAs now. And throw your contribution into an S&P 500 index fund. Let it compound for 20, 30, 40 years completely tax-free. No capital gains taxes. No dividend taxes. Nothing. Compare that to a regular brokerage account where you're getting taxed on gains every single year. Over 3 decades. That difference is absolutely massive. I ran the numbers. If you max out an HSA with $3,900 every year, invest it in the S&P 500, and average 10% annual returns, which is historically accurate, you're looking at $750,000 in 30 years. That same strategy in a regular investment account with annual taxes, you're at roughly $600,000, $350,000 from tax efficiency alone. Tax advantage number 3. Qualified medical withdrawals are completely tax-free. This is the knockout punch. You can withdraw HSA money for qualified medical expenses. And the list is extensive. Doctor visits, prescriptions, dental work, vision care, physical therapy, hearing aids, even certain supplements. You pull the money out. You owe 0 taxes on the growth. 0 taxes on the withdrawal. It's the only account in America where you get to access your money tax-free for specific purposes. But here's where most people mess up their strategy. And I'm about to show you how to exploit this legally. The power move nobody talks about. Most people use their HSA like a checking account. They get sick. They pull money out immediately. That's leaving massive gains on the table. Here's what I recommend. Pay your medical expenses out of pocket. Completely out of pocket. Keep receipts. Don't touch your HSA for 15, 20, 30 years. Let it compound. Meanwhile, your HSA grows untouched in the stock market. Then, decades later, you withdraw for those old medical expenses tax-free. You've got receipts. You're completely compliant with the IRS. You basically created a second retirement account with even better tax treatment than your Roth IRA. Why is this better than a Roth? Because your Roth contribution limit is $7,000. Your HSA limit is $3,900. So your Roth gets more annual room. But if you've maxed your Roth and you've maxed your 401k, the HSA becomes your next best tool. And the tax-free growth is identical. Real numbers. Real scenario. Let's say you're 30 years old, healthy, and you max out an HSA with $3,900 every year for 35 years until you're 65. You invest it all in a total stock market index fund. Average 10% returns. You never touch it. You end up with $1.2 million. Completely tax-free access to all of it. As long as you're using it for medical expenses. You could retire early, use that for healthcare, and never pay a single dollar in taxes on those earnings. Here's your action plan. First, check if you're on a high-deductible health plan. If not, consider switching. Second, open an HSA with Fidelity or Vanguard if your employer doesn't offer one. Third, invest it immediately, not in cash. Not in money market funds. In an S&P 500 index fund or total stock market fund. Fourth, pay your medical expenses out of pocket and keep those receipts. That's it. You've just unlocked a wealth building machine that most Americans completely ignore. If this video helped you understand HSAs, hit that subscribe button. We break down financial strategies every week that could literally save you thousands of dollars per year. Thanks for watching. I'll see you in the next.